Welcome. In this video, XCN can increase by 400% if it completes the bullish pattern. But will it be able to complete the pattern? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
Support levels are one of the critical zones in financial markets that cause the price to pause or reverse at a certain point. Support acts like an invisible floor beneath the price. These are the points where the price has previously paused, reacted, or changed direction when it fell. For this reason, in technical analysis, support zones are among the most closely watched areas by investors. Having a support level where the price is currently located provides a significant technical advantage. If the price bounces from this level, it can create a strong foundation for an upward movement. The most important feature of support levels is that there are areas where buyers have stepped in strongly in the past. Therefore, when the price reaches the same level again, many investors see it as an opportunity and start buying. This collective buying behavior can cause the price to turn upward. Support zones often appear on charts as a clear horizontal line or a band. When the price bounces from these zones, it's as if it's saying, "I don't want to go lower from here." If this support level has a strong history, meaning the price has reversed from it multiple times in the past, the likelihood of it holding increases even more. The fact that the price is currently at a support level means it has caught the attention of buyers in the market. Investors tend to buy here with the expectation that the price will not fall further. This creates an increase in demand in the market. When demand rises, the price starts to move up. Rises from support levels can sometimes be short-term reaction moves, but they can also turn to long-term rallies. This completely depends on the strength of the support level, market psychology, and the overall trend. If the overall trend is already upward and the price has reached this support due to a temporary correction, the likelihood of a bounce is much higher. Support levels also have a strong psychological effect. For example, many investors make plans such as, if the price falls to this level, I'll buy, while watching the chart. These levels are strong support zones. When the price reaches this point, buyers step in and push the price up. In technical analysis, this is also referred to as a buy zone. If this support overlaps with moving averages, Fibonacci levels, trend lines, or other indicators, the reaction from here can be much stronger. In other words, the effect of a support level becomes more meaningful when evaluated together with other technical factors. A rise starting from a support level is usually accompanied by an increase in volume. The more buyers step in, the more trading volume there is. Volume is an important indicator that the rise is healthy. A low volume reaction may fade quickly, while a high volume reaction can help the price stay higher for longer. Volume is one of the most important tools for confirming the strength of a break or bounce at a support level. If the current bounce from support happens with high volume, the probability of the move continuing is very high. Looking at past price movements, a bounce from support often heads towards certain technical targets. These targets are usually the previous peak, the next resistance level, or the upper band of a channel. So a bounce from support is not just a small recovery, but it can also be the beginning of a new uptrend. Especially if this support corresponds to an important zone on larger timeframes, daily or weekly charts, the price can move strongly upward from here. The logic behind a bounce from support can be explained with the supply-demand balance. As the price falls, some investors think it's becoming cheaper and start buying, increasing demand. At the same time, sellers might find it unreasonable to sell at such low prices and stop selling, which decreases supply. With supply decreasing and demand increasing, the price rises. This is where the strength of a support level comes from. Of course, not every support level will always hold. If there is very negative news flow in the market, strong waves of selling, or a heavy concentration of stop-loss orders just below the support level, the support can be broken. In this case, the price may fall to the next support level. However, if both technical and psychological conditions are favorable for a bounce at the current level, an upward move is quite possible. Especially if the price has bounced from this level multiple times before, investors will take it as a reference. In the current situation, the importance of the support level is even greater, because if the price can hold here, it will generate a positive signal for both short-term traders and long-term investors. Short-term traders might buy here to sell at the next resistance, while long-term investors might calculate that a rally starting here could last for months. Having both groups buying at the same time contributes to the price rising much faster. In addition, a bounce from support often triggers technical patterns. For example, the price may bounce and then form an ascending triangle or an inverse head and shoulders pattern. When these patterns are completed, the potential for a rise becomes even stronger. This means that a move starting from support can be the first step of a much larger upward move towards significant technical targets. In such a scenario, holding the support level increases investor confidence. As confidence grows, more investors buy, adding to the momentum of the price. If this upward move is in line with the overall market trend, the bounce from support can even be seen as the beginning of a trend reversal. But we can't decide based on support alone, so let's take a look at other metrics as well. Keep watching.
The MACD indicator is one of the most commonly used tools in technical analysis to understand trend direction, momentum strength, and possible reversal points. MACD stands for Moving Average Convergence Divergence. As the name suggests, it measures the relationship between two different moving averages. Essentially, the MACD line is obtained by subtracting the 26-period exponential moving average from the 12-period exponential moving average. The signal line is the 9-period exponential moving average of the MACD line. The histogram visualizes the difference between the MACD and the signal line. This entire structure provides investors with a powerful tool for understanding price momentum and direction. An upward MACD crossover gives important clues about the future direction of the price. In particular, an upward crossover, where the MACD line crosses the signal line from below, is generally considered a bullish signal. The logic is quite simple. The MACD line reflects short-term price momentum, while the signal line is based on a longer-term average. If short-term momentum crosses above the long-term average, it shows that the price is gaining strength and that an upward movement may be starting. An upward MACD crossover often appears at a trend reversal point or during the continuation of an existing uptrend. In other words, it can be used both as a trend reversal signal and as a trend confirmation signal, especially if the price is held at an important support level or if other technical indicators are also giving buy signals. The MACD crossover strengthens the bullish scenario. In technical analysis, when indicators support each other, the reliability of the signal increases. The advantage of MACD is that it can both follow trends and measure momentum. An upward crossover not only implies that the price may rise, but also that this rise could be strong. This is because short-term momentum surpassing the long-term average indicates that buyers are gaining strength in the market. At this point, an increase in trading volume is also a sign that the uptrend is starting on solid ground. Investors often try to catch a MACD crossover at price bottoms. This way, the risk is low and the potential return can be high. Especially after a long downtrend, an upward MACD crossover is often a harbinger of a strong trend change. For this reason, many investors see such crossovers as buying opportunities. For an upward MACD crossover to be effective, the price usually needs to be aligned with the overall market trend. For example, a crossover that occurs during a general bull market is considered more reliable. Crossovers during a bear market, however, are often weaker and may be limited to short-term bounce movements. Therefore, when evaluating MACD signals, it is important to analyze them together with the general market trend, support resistance levels, and other technical indicators. An MACD crossover doesn't form and end in just one candlestick. Most of the time, this crossover process continues for several candlesticks, giving the investor an opportunity to assess the sustainability of the move. If the histogram begins to rise above the zero line after the crossover, this shows that the upward momentum is strengthening. The histogram's expansion in the positive zone confirms that the price's upward momentum is continuing. At this point, when determining potential targets after a MACD crossover, investors usually refer to previous highs, important resistance levels, or Fibonacci levels. This is because an upward crossover often pushes the price toward these technical levels. If the price also breaks through these levels strongly, the uptrend can accelerate further. Another important point is that there can be false signals in MACD crossovers. Especially in sideways markets and low-volume environments, the MACD can produce many false crossovers. Therefore, investors should evaluate the crossover not alone, but together with price action and volume. For example, both a MACD crossover and a breakout of a resistance level by the price reduce the likelihood of a false signal. The historical performance of MACD also gives investors confidence. When MACD crossovers are examined in past price charts of certain assets, these signals are often seen at the start of many major uptrends. Of course, no signal works perfectly every time, but in general, upward crossovers, especially under the right market conditions, can offer profitable opportunities. If the current chart shows that a MACD upward crossover is about to occur or has just formed,
This technically indicates that buyers are gaining strength and the likelihood of the price rising has increased. In such a scenario, investors can control their risk by placing stop loss levels below support zones and potentially benefit from the upward movement. Especially if this crossover is supported by other technical factors such as a bounce from strong support, a pattern breakout, or increasing volume, the probability of the price moving upward becomes even stronger.
The flag pattern is an important formation in technical analysis that indicates the price has entered a short-term consolidation phase after a strong move, and may then gain new momentum in the same direction. It gets its name from its appearance, as the price chart forms a structure resembling a pole, followed by a small flag. This pattern is considered one of the continuation patterns and typically appears after sudden and sharp upward or downward movements. In this scenario, we are looking at a bullish flag formation, meaning the price moves into a short-term horizontal or slightly downward sloping channel after a sharp upward movement and then enters a new wave of upward momentum once the upper line of this channel is broken. The formation process of a flag pattern is quite distinct. First, the price makes a strong upward movement, which is called the flagpole. This rise often occurs with high trading volume, as buyers dominate the market and sellers pull back. After this rapid increase, the price moves sideways or slightly downward within a channel. This channel represents the fabric of the flag. During this phase, volume generally decreases because the market is catching its breath. Buyers gather strength for a new move, while sellers failed to push the price down significantly. The most critical point of the flag pattern is when the price breaks the upper line of this small channel. When the upper line is broken, the likelihood of the previous strong uptrend continuing is quite high. In technical analysis, the target measurement for this pattern is usually the length of the flagpole. This means that from the breakout point, the price could rise by the length of the pole again. In this scenario, this measurement indicates a potential rise of 400%. This is a significant rate of increase and represents a serious profit opportunity for investors. The calculation of this 400% rise potential usually follows this method. First, the price difference between the start and end points of the flagpole is determined. Then, this difference is added to the breakout point. If this difference indicates an increase of around 4 times the current price, this means a 400% rise expectation. Of course, such expectations should be evaluated within the scope of the probabilities offered by technical analysis and are not guaranteed. However, the historical performance of the pattern and market psychology showed that such a move is possible. The flag pattern is also valuable for understanding investor psychology. The sharp rise in the pole portion is usually triggered by news, developments, or a strong technical breakout. At this point, FOMO kicks in, and many investors rush to buy. However, no price rises indefinitely without pause, therefore short-term profit-taking occurs. These sales push the price into the short consolidation area of the flag. During this stage, both buyers and sellers reposition themselves. Buyers wait for the right time to make another jump, while sellers encounter a strong group of buyers that prevents the price from falling too far. The breakout moment usually comes with a noticeable increase in trading volume. Volume is the most important confirmation tool to determine whether the breakout is genuine or fake. If the price breaks the upper line with strong volume, it shows that buyers are determined and the rise is likely to continue. Breakouts without volume can sometimes fail and the price may return into the flag. For this reason, professional investors pay close attention not only to price action but also to trading volume and flag patterns. A high target like 400% can create great expectations among investors. However, risk abridgment is extremely important here. Although technical analysis shows such potential, market conditions, news flow, and the general trend direction can affect whether this target is achieved. Using a stop loss is essential in trades with such high profit targets to keep risks under control. Usually, the stop loss is placed just below the lower line of the flag pattern. This way, if the pattern fails, losses remain limited. One of the best features of the flag pattern is that it can be used by both short-term and medium-term investors. Short-term investors can benefit from the rapid price movement after the breakout, while medium-term investors can wait for the pattern target to be reached to gain larger profits. Although the 400% potential looks like a medium-term target, sometimes if market conditions are favorable, this move can happen in a shorter time. Historically, flag patterns have worked successfully across many assets and in different market conditions. In the cryptocurrency market in particular, such patterns are common because volatility is high and prices can make sharp moves in a short time. Investors can study past examples to see in which conditions the flag pattern works better. Often, strong fundamental news or an overall positive market mood increases the chances of a successful breakout. Another notable aspect of this pattern is that it gives psychological confidence to investors. During the formation phase, the price does not fall much, showing that buyers are still active in the market. The breakout moment strengthens this confidence. When the price rises by the length of the pole after the breakout, it confirms the measurable target concept in technical analysis and helps investors develop strategies. In this scenario, breaking the upper line targets a 400% rise. This means the current price could increase 5-fold. Such a move would not only increase capital value, but also significantly boost morale and motivation among investors. For this reason, many traders see catching the breakout moments of such patterns as one of the most critical strategies.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.